Okay, so in this video I'm going to take you through how to complete the balance sheet for Hickson, the question we did just a while ago. And you'll see that if I go back to the trial balance, we're going to use all the items we haven't used yet, which are essentially all the ones I did the initials next to there. You can see NCA, CL, CA, EQ, NCL and CA. Those are the items that go on the balance sheet side. So if you look at the balance sheet, we've got the headings NCA, non-current assets, CA, current assets, EQ, equity, NCL, non-current liabilities, and current liabilities, CL. Essentially what we're going to just do is take the figures from the trial balance and put them under the correct heading. It's really important that you look at the glossary because it gives you a bit more of an explanation what these figures are. So take the figures from the trial balance of those non-current assets and put them in this first column, which is the cost column. Add them up and you should get 200,000. This middle column is called provision for depreciation. We're not going to use it yet because I haven't taught you how to use it or how to calculate it. Essentially, depreciation is the fall in value of a non-current asset. At the moment we're going to leave it blank, indicated by a dash. And the last column, this one over here, is called the net book value, which is essentially the cost minus the depreciation, provision for depreciation. So as we've got no depreciation, the net book value of our assets are still the same, 200,000. Then we come to the current assets, which are short-term assets, and there are normally 3 or maybe 4. And as you look in your glossary, you'll see it's inventories, trade receivables, bank, and cash. Depends on the question you got. You might not have all of them. Inventories is 49. And I'm just going to show you. It's the inventories. Always this one at the bottom of the page, the one at the end of the year. You take that figure and you put it in there. Trade receivables, you'll see that's on the trial balance. And if you look on the trial balance, we don't have any more CAs. Okay, you might be tempted to think bank goes there, but you'll see in a second it's not actually a current asset. Put the totals in. We need to add 49 and 50 together to get a total of our current assets, and that's 99. Underneath there's another heading, subheading to the side called total assets, and what we want to do is add our non-current assets total to our current assets total, and then you end up with 299. I'm going to highlight that yellow because we're going to need that figure later on to check if our accounts are correct. Equity is the next heading under equity and liabilities. Share capital, share premium you get from the trial balance. You don't have to do anything with it. But remember earlier on the first video I said retain earnings. We worked that out already at the bottom of the sheet. And I said, remember this number here? I said that's the figure that you need to take and put in the balance sheet. You put it in there. Again, we need to subtotal it. We need total equity, add them all up, and you get 209. Non-current liabilities is always the bank loan. Take it straight from the trial balance, and underneath we just have to add it up, which is 50. Then we come to the current liabilities, which are your short-term liabilities, people you owe money to within 12 months, and you have to pay them within 12 months. Trade payables is definitely one. Take it straight from the trial balance. Loan interest payable. Okay, and if you go back to the trial balance, you'll see, sorry, wrong sheet. There it is. Anything the word payable is a current liability. Put it in. It's 6,000. And the last one is corporation tax payable. Again, go to the trial balance. There it is. 7.5. We're going to put that in as well. Last thing is to show you one quirky little thing. The bank. Now, remember I said there are always 2 columns on the trial balance. The one on the left and the one on the right. Whenever you see the bank on the right hand side, it's always a current liability. And if you check, it's always the same side as anything with a payable on. Can you see loan interest payable was a liability and we put it under there? Same side, put it under current liabilities. So essentially, it's a bank overdraft. Total it. So, and then we need a total of our total liabilities, which is the non-current and the current. Add it together. You get 89.5. Finally, we need a total for equity and liabilities. We're going to get the 89.5, and we're going to add it to our total equity of 209,500, like so. And you'll find it's 299, which is the same as total assets.